Hey everyone, it's Paul with Investment Tuesday. And in this Investment Tuesday, we are going to cover the event of the year, the event of certainly the last few years that people have been anticipating, looking forward to with bated breath, with excitement, anticipating, and it's finally happened. And in this Investment Tuesday, we are going to get into, well, now what? As you know, if you've been watching this YouTube channel, you know that the event I'm talking about is the Federal Reserve cutting interest rates, and it finally did that last week. And for the most part, it wasn't really much of a reaction, right? I mean, it's not like stocks exploded higher by 100%. It's not like, everything went haywire. None of it happened. It kind of was like, okay, they cut. There was like a little bit of a reaction, and then everything kind of went back to business as usual. So in this Investment Tuesday, we are going to deal with the topic, the Fed cut. Now what? What happens from here? So we are going to cover that, and I am going to tell you where I think you should put your money for the now what part of that subject line. All right, before we do that, let us quickly go through all of the usual things we do at this point in the podcast, which is our legal disclaimer and disclosure, which is that this video and all the content from ATG Digital is not investment or financial advice. It is presented to you as my opinion, my view, my take, our take on the world. You use it as information, engagement, or entertainment. Whatever you choose to do with it, it is your responsibility because it is your money. All ATG Digital content may contain errors, oversights, and mistakes. Understand that investment operations, which are buying or selling a stock, crypto, options, anything else, have significant risk and can lead to the loss of your principal, meaning you could lose money. I, the owners, employees, contractors of ATG Digital, we own, trade, transact in the securities that are mentioned in this video and all content from ATG Digital. We do not take money from company managements or crypto sponsors to recommend their stocks or crypto tokens. We publish an extraordinary amount of content on a daily, weekly, monthly basis. Some of it is free, and the Ballman Speculating podcast on Spotify is free. Obviously, I'm on YouTube, and then we are on Substack every market day. What's a market day? Well, when the market's open. And in our Substack, we cover market commentary, sort of like overall strategy, macro, stock picks. It's like a little mini version of what you get if you are a subscriber to ATG Digital. Social media, X, Instagram, Facebook. Check us out at all these places. You can choose to join and become a member of this YouTube channel. And you would go and you see that little join button there. You would do that by doing that, and you would join us. And what are the benefits of being a member? You get early access to my YouTube video, and then we have special content that is for members only. Also, you could choose to be a subscriber to ATG Digital. Remember, in a world of AI where websites can be cloned, pictures can be cloned, you need to make sure that you are on this specific website, atgdigital.media. Yeah, don't go by the picture. Don't go by like, well, it's purple, atgdigital.media. It's got to say exactly that, because there are a lot of people that are trying to copy us and to try and get money out of you. All right. I have a lot of notes, and I'm going to show you some notes. And it gets, let's say, to the first part of the subject line, which is that interest rates got cut, right? Now what? Well, I just want to give a very quick lesson, if you will, of the difference between this interest rate cut and pretty much most interest rates cut over my investment career. Now, it's not completely unique. I do recall one or two cuts where conditions were something other than what I'm describing. But for the most part, when the Federal Reserve cuts interest rates, it's usually a scenario like this. All right, I'm going to show this picture up, and I guess everything's reversed, so it's not much I can do, but I'll just try to do this, which is that when the Federal Reserve usually cuts rates, employment is going down. In other words, people are losing their jobs. Consumption and spending is usually going down. I'll get to this part of the arrows next. Inflation is usually going down because, well, if people are not consuming and spending, well, people start to cut prices to try and get people to spend. Asset prices are usually going down. The stock market's crashing. Real estate is down. Essentially, anything with risk, right, is going down in price. And general macro conditions are generally, not favorable, right? I mean, but in the scenario we have today, we have a more complicated, unusual, and different picture than what it's been like when the Federal Reserve usually cuts interest rates. And before I say that, the net effect of cutting interest rates is that it pushes money into the economy, right? And that's the reason to do it. In other words, if you cut interest rates, the idea is that it will stimulate, economic activity. Businesses can take loans. As a result of those loans, they can buy things from their suppliers. They can hire one more person. So that's the end benefit of cutting interest rates. But in the scenario where we're in, employment is not going down. Yes, I know that people can make a scary story while, it's weakening, but that might happen into the future. But at present, the unemployment rate is something in the range of 4.3%. It's certainly not a disaster, nothing compared to, what we have seen in the past that would be considered problems, crises, or panics. Consumption and spending, there is a small slowdown in spending, but for the most part, retail sales, etc., I mean, they continue to be what they have been. There really is not yet a major slowdown, either consumption or spending. Inflation, well, here's where the biggest difference is, which is that over my entire career, which stems over 30 years, the standard was 2%. If inflation was over 2%, the Federal Reserve would be like, we got to fight inflation. There's no cutting of interest rates because inflation could, go out of control, and we will keep interest rates high. We have sort of changed, if you will, the standard, changed the benchmark and the hurdle, which is that the Federal Reserve now is like, well, 2% was made up to begin with. And because we kind of kept interest rates too low after the global financial crisis for so long, and then we did so many manipulations of pretty much every asset market, the stock market, the bond market, etc., we're kind of stuck, which is that we kind of need slightly lower interest rates for housing, for people to buy cars, etc. And so we're gonna fudge the 2% standard and be like, that was kind of made up. And right now, inflation is running at let's say between 3 and 4%. And we're going to be like, well, it's not going up very fast from there. It's kind of stable in that range, and we are going to cut. All right, and that's what they have done. And in their announcement press release, they said that not only did they cut this week, but they're planning to cut over the next two meetings, so at least another 0.5%, let's say by year end. Despite inflation, actually, it's not rocketing higher like it was in 2021, but it is still inching forward, and we are nowhere near the prices that we had pre-COVID, right? I mean, the prices of almost everything are up, I'll say, on the low side, 20%, on the high side, 60%. And that's kind of where we are. We're not going back to that. All right. Asset prices. Well, I mean, asset prices, what? Stocks, real estate, junk bonds. By assets, I'm talking about things that are, have some risk. In other words, this is not cash, and you worry about the price going up and down. Asset prices, well, the S&P 500, the NASDAQ 100, record highs. Real estate prices in some markets have been like in decline, but the overall US real estate market somewhere near all-time highs. Junk bonds, why do I bring up junk bonds? Because, well, I mean, these have risk. And when people are willing to buy junk bonds, it says that, hey, I'm willing to take risk uh, in exchange to get higher yields, essentially higher returns. So asset prices, which reflect risk, are all at near around all-time highs. That is very unusual. I mean, you do not get that. I mean, for contrast, in 2008, when the Federal Reserve was cutting, right? I mean, asset prices were, down 50, stock market was down 50%. I think real estate was at that point down maybe 20, 25%, and there was another 10% more to go over the next couple of years. Junk bond spreads were high. In other words, nobody wanted to buy anything with risk. Everybody wanted cash. Not the scenario today. Today, everybody wants assets. Why? Because we've had this enormous asset boom from 2009 onward, stimulated by very low interest rates. And we also have had a new generation of investors who have never really gone through a bad period, that are backward looking and being like, look, the stock market only goes up. Bad things, if they happen, the Federal Reserve will cut and they'll make it better. So essentially, you buy the dip and you never need to worry again. That is, more or less, okay, I'm making it into, a soundbite, but that is a viewpoint of most young investors. And then another big difference is these macro conditions. In my 30 years, we never really talked about tariffs. Like, I mean, I have been investing professionally. 30 years, I'll say, my first job where I was actually in control of money was probably in 93, 94. So 31 years. We never really had a discussion about tariffs. Almost all the discussions were about how much free trade we're going to have. Will NAFTA pass? Should it pass? Well, who would it impact? What industries? Today's a very different story. We're talking about tariffs, what the impact is on a global basis for the global economy, country by country, and then industry by industry. And we have just begun, so we don't really know, right? And the fact that asset prices are at all-time highs, they're acting as if they know, and we don't know. I mean, literally, we just began in 2025, right? So we've got these tariffs. The U.S. is now taking in $250, $300 billion in tariffs. What is the long-term impact of that, the global economy, on the U.S. economy, on various industries? Really, at this point, we have to say we don't really know. We've got major wars going on. Okay, there have been wars in my 30 years. There was the Gulf War I, there was the Gulf War II, there was the global war on terror. But we have, the Russia-Ukraine war, which is significant because this has now been ongoing for several years. Now, the various Gulf wars were kind of short in terms of their duration, but the Russia-Ukraine war is sort of like there's no clear end to this. President Trump, when he came into office, he admitted this week, saying that he thought this one would be the easiest to solve, and that he hasn't been able to figure it out. And that is because it deals with longstanding issues, claims between Russia and Ukraine that go back, hundreds of years, right? However, in the middle of all of that is major issues around commodities, right? Russia is a major player, I mean, with a, big M in oil and natural gas, which has enormous implications for the economy. I mean, despite whatever people may say, etc., we need oil. We need a lot of natural gas to power up electricity, etc. And that's not going away anytime soon. And to the extent that, this Russia-Ukraine war keeps burbling along slowly, you can see The United States, Europe, sort of like pushing themselves more into it. Now we have Ukraine, attacking the largest refinery in Russia that is obviously with the backing of the United States and the European Union and other allies. So this keeps, going forward. We also have, a sort of simmering war that has gone on between India and Pakistan. And then the whole Middle Eastern region between Iran, Israel, and what's going on there continues to be something that, like, there's no clear end marker. There's no peace agreement in place. And so all of these keep ratcheting, into a scenario where these are risks that at all-time highs, people are like, 3 wars, who cares? Yeah, Russia, one of the largest producers of oil and natural gas to the world. Who cares? India and Pakistan, both nuclear powers, who cares? Iran, Israel, obviously oil, energy, nobody cares. So that's different. In previous wars, there was a very clear end game where the United States got involved. There was like some coalition, and they were like, this needs to end. And it kind of like ended. But here, all 3 wars, no real sign of an end. Finally, something that nobody really talks about very much, which is demographics. After say 70 years of worrying that the world was going to run out of resources, run out of everything, we instead have something different going on, which is that we're running out of people. Demographic decline is well on its way in Japan, which is the fifth largest economy. It's well on its way in the vast majority of Western Europe. It's also on its way in China. So this is a major issue, which right now is kind of small. But nonetheless, this is a big deal. I mean, we have every economic and financial estimate is based on the idea that we will have more people, right? I mean, it's every estimate, any long-term estimate is essentially an extrapolation, from here, 3% every year. And we have assumed that. Once you start to do this in reverse and say, well, we're going to have, let's say starting 2050, 0.5% fewer people, then we're going to have 1% fewer people, then we're going to have 2%. This has major implications. And you might think, well, Paul, I don't really care what's going to happen in 2050. But if you are planning for anything major, roads, airports, you would care, because otherwise you're going to put up facilities or plants or factories and all these things that nobody's going to use. Most of those things are paid for by investors through bonds. And if you're an institutional investor, you care. You care because whatever it is, maybe a government authority, you want new roads, you want a better terminal for your airport, you want some building to be built in your town, or you're going to have to go to institutional investors and you're like, but your town is shrinking. Your city's shrinking. Heck, your state is shrinking in terms of people. We don't really want to give you the money. So interest rates would go up as a result. Okay, enough about that. That's something longer term. But my general point is this, which is that the Federal Reserve has cut into a pretty complex set of conditions. This is not like, a scenario like 2009, where stock markets had crashed. People were in abject, utter fear. There was talk of the next Great Depression, etc. Asset prices were incredibly low. Generally speaking, everyone was like, well, we need to essentially make sure that the next Great Depression doesn't occur. So let's work out all these different things. While it may sound trite to say, the set of circumstances we're in were in some ways quite simple. Everyone needs to be like, listen, yeah, I mean, we're going to keep interest rates low until confidence comes back. What parts of the economy can potentially grow? How long is it going to take? And everyone was pretty clear that unless there was continued sort of like action by the Federal Reserve, asset markets would do nothing. But they pumped extraordinary amounts of money into the economy, lifted asset markets higher, didn't lift really economies higher. And in some ways, they seeded some of the problems that we have today. But that's neither here nor there. My point is that very, very different set of circumstances, right? I mean, what we have here is the big thing is that asset markets are at all-time highs, while you have major risks that are not discounted, not anticipated by markets, right? And here is why I bring this up at all, which is that when you look at indices like the S&P 500, the NASDAQ 100, you know the story. I've been telling this story for some time. My best guess is you don't want to hear it. It's unpopular, and that's fine. It's never popular to tell people that the party's ending, or that the party's out of control, and that there might be still maybe a couple of hours of a good time, but it comes with certain risks, comes with certain problems, and you know what? It's best to leave, before these really get, like significant where you're involved in it. And once you're involved in it, it's difficult to kind of get out. So here's what I came up with in terms of like, well, the Fed cut. Now what? Well, number one, we have a lot of companies that trade in the stock market, particularly the most popular companies. I'm talking about the ones most involved with artificial intelligence, generally technology. These are, in many cases, fine businesses that produce a lot of cash, produce a lot of sales, produce a lot of earnings. However, there's this element of investing that retail individual investors sort of like, I think, have trouble wrapping their head around. And this is not a knock on retail individual investors. I think their retail individual investors often have very good qualities, like they're quite loyal to their companies, etc. But some of the psychological elements are just something that require a sort of like a brain twist. And here's one of it, which if you read extensively on markets, you'll come across, which is that at very high prices, which is where we are, and that's obviously a judgment call on my part. And by very high prices, I'm not just talking about absolute prices of like, well, each share of NVIDIA is $170. I'm talking about valuations. You can listen to my Ballman Speculating podcast that was published last, where I go into this. Valuations might mean what? Well, comparing a company relative to its earnings, comparing a company relative to its sales, comparing a company relative to its cash flows, they are at record high prices, right? So at these prices, even the finest, best companies, they become a complete speculation. And why is that? Well, because the professionals don't simply look at the stock price and view it as like, hey, the stock price is going higher. That's good. They also then compare the stock to the business that it represents. And individual and retail investors often, even if they understand that, they have trouble seeing the point, being that if the stock price is going up, how can that be bad? And if the stock price is going up, of course I want more. Why would I sell to get out of this party? And so as a result, from having, been in two market peaks, the 2000 peak, the 2008 peak, what happens is that people tend to buy the most amount of stock using leverage somewhere near the high. And once you get in and the market doesn't, give you what you want, which is what? It stops going higher, or it stops going higher fast enough. Now it starts to create first a small set of losers, then more losers. And having gotten in at high prices is very difficult for people to get out because they're like, well, I don't want to lose any money. The psychological phenomenon is called loss aversion, which is like we hate taking losses. So then people think like, well, okay, well, when it gets back to the old high, I'll sell there. And then it doesn't get back to the old high. And now you're in this like this circular logic of where you're constantly like pegging for the next low high. In other words, it's no longer here anymore. You're like, when it gets here and it gets here. And I saw this happen particularly among my friends, colleagues in the 2000 top, where they bought in, I'll say late 1999, even early 2000, and they just couldn't bring themselves to sell. Not for, some of them for smaller profits. They're like, well, but I was up 100% and now I'm only up 70. I don't want to sell. And then eventually it's like, well, I'm now down, 20%. I was now once up 100%. I'm just going to write it out. These are some of the psychological traps that, you can get into at tops. All right, next. This is controversial and unpopular, but most contrarian opinions at near around market peaks are both controversial and unpopular until something happens. And then, people, will say, oh yeah, that was a great call, etc. The thing is that, you have to make that call, quote unquote, before the thing happens, right? I mean, people, go back and watch the movies of the global financial crisis, and Michael Burry is a great hero. But he wasn't a great hero while he was telling people like, listen, there's this enormous, mortgage finance bubble. The investment banks, don't have enough collateral. Nobody really wanted to hear that story. It was only after he was, turned out to be correct that people, now like, oh yeah. So here's my unpopular and controversial opinion. Obviously, people are like, well, Paul, you're the only one saying it. Hey, that's all fair and that's fine. You disagree with me, that's fine. As a mentor used to tell me, reasonable people can disagree, and that's okay. And here's my view. I would not chase the big tech companies as they hit ever higher prices and valuations unless you know and decide and peg when you're going to sell them. And that is related to what I mentioned earlier. I've seen that once prices reverse, it becomes hard to let go of the previous highs, and you lock yourself into those profit levels, and so then you end up getting trapped in what I call a high expectations mindset. Well, you'll only sell for like the previous high price that, over time, is simply not available. Next, I would also not chase the very highly speculative stocks in quantum computing, nuclear energy, the semiconductor stocks, which are many of them are the AI stocks. And here's the part that will be difficult to take, which is that they all could go higher. I mean, one of the things that I know from reading books about stock market peaks is that a high often generates another high because, well, retail individual investors and most investors see a high as a reason to buy more, right? Because the benefit, of course, of being in markets is to see your account go up. Now, at extremes, professional investors slowly start to opt out and cash out and start to raise cash. And we have seen that. Warren Buffett has, I think, nearly $400 billion in cash sitting in T-bills. Howard Marks, who's a very, very, highly reputed investor, talks about how the S&P 500 is a bad deal. But since he said that months ago, the S&P 500 has continued to make highs. Why? Because there is this reflexive activity, which is that if prices are going higher, there's always some number of investors that want more, and they will bring their capital and bid prices higher. So while they all can go higher, in my judgment, the downside risk gets ever greater with the higher the price that you pay, and it will be, greater than any upside that you can get. All right. Now I don't want to say okay, it's all a big problem. No, there are places definitely that I would tell you, in my judgment, are not bid up, or they're bid up in that in-between place. Like, when markets are at a peak, nobody really wants to sell. And And that means, that's kind of dangerous territory, because usually means there's a lot of very short-term investors using leverage, and that, like, they need higher prices, all the time. However, there are markets when they're in between, when you see rising high prices. Not everyone is yet invested. People a little bit skeptical, so they don't own it yet. So there's a lot of latent demand that can come in. And I will say that, that I've been talking about the flight to scarcity, which is trades in gold, silver, and also crypto, right? And this is a good point to say that if you are looking at crypto, well, check out our Bitcoin trigger report. You click on this link above here, and it will give you our 100% free Bitcoin trigger report. So click over here. The major crypto is, got the three elements of going up in the scenario that makes me feel like, hey, these could go higher, and it's not at such a top or extreme. How do we know this? Well, there's no euphoria really about Bitcoin. I mean, nobody really, is crazy about it. I mean, I was around in the 2017 market. And that was euphoria. That was crazy, right? Everybody wanted Bitcoin. Everybody wanted in. We don't have that now. So we've got the elements, which is that relative to demand, crypto, especially the top tier crypto. I'm talking about Bitcoin, Ethereum, XRP, Solana. We just added, 11 crypto to ATG portfolios. So if you're a subscriber, you know what they are. And if you want to get a sense for like, hey, how do we think about crypto? Check the Bitcoin trigger report by clicking on this link up here. All right, that's, one of the places. Where else can we go? Well, come on and touted electricity to all of you. And I want to show you something that I found this week that justifies everything that I've been saying, which is, here you go. It says U.S. electricity prices hit record highs from AI data centers. Hey, they're singing my song. I've been telling you that electricity is, in my judgment, in these market conditions where you want to focus on safety, you want to focus on companies that are not bid on price, where the expectations are not euphoric. And if you go and look at companies related to, they're not all electricity companies, natural gas companies, natural gas storage companies, pipeline companies, all of this entire chain, they're all not bid up. And so this is a very large bet at ATG Digital. I actually put together all of the portfolios quite recently and shared it with our purple tier members. And we have 26 companies in the AI space. Tesla is one of them, so throw that out. And then we've got a couple three in networks, but off the 26, 22 are in some way, shape, or form related to the energy opportunity, and they are this mix of either companies that have capacity that they can sell into a booming market, or else they have natural gas resources that they produce, or they have distribution assets, which, of course, as prices go higher, they will keep asking for more money. Why? Because they represent monopolies. There's only one pipeline that serves most areas. Why is there only one pipeline? Well, I mean, go read your paper, environmental objections, regulatory objections, all of these things. So electricity prices, electricity is one of these things that in hindsight, people be like, oh, that was really obvious. I could see that my electricity bill was going up all the time, and I sure really bought like my local utility. And my best guess is that is probably a pretty good bet. Next up is oil. I'm not going to talk about stocks in oil because we literally just added them to the portfolio over the last week or so. But we have focused on a very particular type of oil company whose costs are fixed. Right now, oil is at $60, $65. That is the chart of oil. And make it a little bit bigger. And here's why. Some oil companies, now I don't want to say all oil companies, because oil companies that produce oil at too high prices, I think, are going to get stuck. But there are a group of companies that have fixed prices because they produce oil in an unconventional way. Right? If you're an ATG Digital subscriber, go and look through the silver tier portfolio and the gold tier portfolios. And we have one in diamond tier as well. And you'll see, well, if you look at these prices, and this is a price chart from 1979, right? I mean, so you'll see that there was a high here in 147 right before the global financial crisis. And then we had a high here of $126, and that is after the Russia-Ukraine war broke out. And now we have essentially come back to where things were sort of before that war, except that the war is still on. And there's a rationing up of tensions, aggression, attacks on Russian energy assets, a major attack on Russia's big refinery. And oil prices really don't reflect the potential risks here. So just, like as I like to say, well, if you go and look at the news, it'll be like, hey, oil is oversupplied, etc. But remember, bad news and low prices go together, except at market extremes, right? I mean, but there's bad news on oil. However, the truth is that we need, all the oil that we can get. The transition to EVs is going to take many decades. We need the oil. And what happens when you have low prices, as we have now, which is that many producers are making no money. They actually might be losing money. High cost producers are losing money. So they start shutting down production. And what happens then? Well, then it sets up for higher prices because it induces scarcity. And that's where we are. Now, the set of companies we're focused on, they've got, unconventional ways, and their costs really don't swing around a great deal. So as oil prices recover, every additional dollar of oil prices just drops their bottom line. These companies, we can see investors bidding them higher already in anticipation of a recovery in oil prices. So do your work, and probably I was going to say in a few months, there have to be some benefits for ATG subscribers to our ideas. I'll come in and present one of these ideas in a YouTube video. And maybe next week for members, I'll show folks one of the ideas and also go into these oil companies a little bit. All right. The next one is royalty companies. I talked about a royalty company, was it last week? Yeah, when I talked about gold and Franco-Nevada. We can see that not just gold and silver royalty companies, but also there is a group of companies in the biotech and pharmaceutical sector. And these stocks are being bid up. Why? Well, the biotech sector is in the middle of the worst bust of my career. There are companies going bankrupt. There are companies selling assets for pennies on the dollar. I've never seen anything like it. Now, we've done okay in biotech and pharmaceutical mostly, but we've also really shrunk down our exposure. And what I believe is happening is that we now have nearly, I'll say, 40 years of data and analysis on success and failure rates of drugs, of clinical trials, of biotech companies. And I used AI to determine this, and I was shocked, stunned. It turns out that the likelihood from discovering, a drug, which is called a molecule, to commercial success right? You got to go through like, 20 years of development. The likelihood of success is like 0.2%, which is about, the success rate of bringing like a gold mine, that will produce, I think, $200-300 million. So very low. And I believe that institutional investors are now much more skeptical, and they're like, hey, royalty companies, they just, what they do is that they pharmaceutical and biotech companies approach these royalty companies and say, hey, we're running out of money. In exchange for a royalty stream, if this drug is successful, give us some money. And these royalty companies have a choice today of, pretty much like all of the companies are desperate for money. And so they got incredible choice. They're picking up quality assets at very low prices. So a very low risk model that is, generates very high margins, because what's a royalty company? It's a bunch of guys in a room taking phone calls. Hey, from X company, hey, we need money. And you'd be like, what do you got? Nah, we're not interested in that. We got like 100 more. So royalty companies are a place that I would be looking at to put new money. Next, I want to share this chart. I put it full screen. Is silver and silver related companies. All right. Well, why silver over gold? Well, look at that chart. All right. The blue line is nominal price of silver per ounce. The goldish looking line is inflation adjusted price of silver. And you can see, if you adjust for inflation, silver prices are really, really undervalued. Right. The old high is a little bit under $50, but this chart says that somewhere, I'll say over the next 1 to 3 years, we're going to have an enormous surge in silver prices. Now, I mean, silver has been going up a great deal. A lot of the silver stocks, and I did present one to YouTube members when I did the gold video. That has rocketed higher, I think, by 30-40% since I presented to them. They're definitely, rocketed higher. So I would definitely be a little wary in terms of putting money there. As always, you want to, buy when prices are lower, even, in whatever your time frame is, right? I mean, if prices are, beginning to make 52-week highs, that's definitely, a point where you can put money in. But if something's been making 52-week highs for, I don't know, 4 months straight, pretty much every day, it's probably time where you're like, okay, I'll inch in a little bit and then I'll wait for a pullback or correction or whatever you want to call it. But bottom line, silver benefits from 3 things. One, in an era of, again, us sort of like changing the goalposts on inflation from 2%. Right now, it's 3 to 4%, but who knows what it will be 5 years from now, 10 years from now. The history on this is poor. Silver is a store of value like gold. Second, I'm going to say when, because it's inevitable that we will have some period of volatility where people will want safe havens. In the previous bull market between 2009 and let's say 2021, the safe havens were long-term treasury bonds, dividend stocks. Yeah, those are no longer safe havens. I believe silver is going to be considered a safe haven. So that's a source of demand number 2, in addition to store value. Third is industrial demand, which is the one that people are least focused on. Silver is an industrial metal like copper. It is used in a lot of industrial processes. And we have really not had a robust growing economy in the United States for a long time. Meaning like, we haven't seen like a 4% GDP growth number in a long time. However, we're cutting interest rates. We got reshoring going on. We got reindustrialization going on in the United States and in Europe. Silver industrial demand is going to go up. So you got 3 sources of demand, which tell me that, somewhere in the next 1 to 3 years, silver prices, they're going to start to approach that inflation adjusted price of silver, and it will stun and shock people when it happens, because Why? Well, because prices have stayed low for so long. All right, last one. I want to mention, which I'm not really going to present any stocks on, which is this is a fairly new theme at ATG Digital, which is monopolies. What are monopolies? Essentially, where there's a one, or in some cases, one or two companies that pretty much dominate the entire industry. And here's an example. I mean, banking. If you want to think of national banking, there's four companies that dominate banking: Citibank, Bank of America, Wells Fargo, and JP Morgan. If you're an international company, you want to do business in the United States, you gotta pick one of them. And there's kind of like no choice. So that's not a single company, but in their territories, oftentimes they are sort of monopolies. We've identified these kinds of companies in healthcare, and as we find more of them, we're going to put them in, because in a era of, again, moving the goalposts on inflation, these monopolies have pricing power. These monopolies can float debt if they need to at lower interest rates. So this is an area. All right, one last thing I want to mention, because this is a group of companies that have been just surging higher, which is what? The Bitcoin miners. And here is the conundrum. You see the headline. It says Bitcoin fee revenue hits multi-year lows, but yet if you look at Bitcoin miners, they are just like looking like this. Even like the long forsaken Marathon Digital is even rocketing higher. What's going on? Well, my view is this, which is that the Bitcoin miners tend to move ahead of Bitcoin. I believe that people who are bidding up Bitcoin miners are anticipating the next peak in Bitcoin, which will come, I believe, in the next 3 to 6 months. So let's say December to March of next year. At least that's what I currently think. They're bidding these higher, anticipating much higher prices for Bitcoin. So Bitcoin miners, are rocketing higher. We've got, I don't know, 8 or 9 of them. I'll say like the lowest gain that we have is for 50 or 60%. And then there's companies like TeraWolf where we have gains of like 400%. But the shocking thing is that they're just beginning to get going. And I think there's like an enormous move that, will go into the Bitcoin high, and then we'll anticipate the Bitcoin high. So if you're looking for reads on Bitcoin miners, well, check into ATG Digital, either our buy and hold portfolios, which are silver, gold, and diamond. But then we've also started to do a lot of option trades in platinum tier around these Bitcoin miners. So check into all of that. All right, we covered a lot, and I appreciate you sticking with me on this. ATGdigital.media is where you can get longer, greater coverage of all the ideas, the actual stocks, and then ongoing coverage, and of course, most importantly, the sell decision. So check us out over there. Thank you for attending Investment Tuesday. This is Paul saying bye.